Hey everyone, I am back with another dividend stock investing video. I want to share with all of you today 9 trends that are alarming to me in the marketplace right now. There are 9 things happening in our world that were just unfathomable to me if you asked me about these, say, 5 or 10 years ago. Now, what's so crazy, though, is a lot of these trends are emerging just within the last 6 months. These are things I couldn't have predicted or seen even 6 months ago. Now, I've been investing in dividend stocks for over 20 years, but what I'm seeing right now in 2022 is unlike anything I have seen before. And so I want to share these trends with you that keep me up at night. But I also have a 10th trend that I want to share that is promising, very promising. And of course, I want to share at the end of the video my updated dividend stock investing strategy. Get ready, everyone. I have a really exciting video in store for all of you today. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I just want to thank you for hanging in there. I know it's been a while since my last video. I fell sick. I was in bed for this last week, getting better. I'm better now. Thank you for all your warm wishes on Twitter and Facebook. Health always comes first, and so I had to delay the videos. But thankfully, while I was sick, my dividends, they just kept rolling in, and that's why I love dividend stock investing so much. And so I want to share alarming trend number 1. As you can see on the screen in front of you right now, I want to talk about mortgage interest rates. Mortgage rates just 6 months ago, just half a year ago, were in the mid 3% range, the low 3% range. Now, they're in the mid 5% range. And so we're up 67% in just the last 6 months' time on mortgage interest rates. We're looking at the highest mortgage interest rates in the last 5 years. And so this is an alarming trend because this affects consumers out there, consumers who are looking to refinance mortgages into a lower rate. Well, it's going to be really difficult to do that anymore. And so these consumers are going to have less cash to spend on goods and services that the companies, the dividend stocks that I own, produce. Also, for anyone out there looking to buy a new home, these mortgage interest rates are going to make it a lot more difficult for those who are looking to purchase their new home or to move into a new residence. And so in general, as mortgage interest rates go up, real estate is going to be stressed a little bit more. It's going to slow down the economy a little bit. It's going to slow down the consumer, and it's going to cast a layer just of pessimism over the marketplace. And this is an alarming trend to me because literally just 6 months ago, this trend was not there. And so this is really affecting financial markets in my humble opinion. Of course, it affects commercial mortgages as well. Let's keep going. As you can see on the screen in front of you right now, I have another alarming trend. The other alarming trend I want to share is just inflation. One of the reasons, obviously, mortgage rates are going up is interest rates overall are going up. The Fed funds rate is going up. The Federal Reserve is increasing the Fed funds rate. In fact, on June 16th, the Fed hiked the Fed funds rate by 0.75. This was the largest increase since 1994. And one of the other things that's really alarming, this is late breaking news on inflation from July 13th. Inflation rose by 9.1% in June in the United States. This is the highest inflation rate since 1981. All of a sudden, we have a ton of inflation. Now, this is not so surprising to folks who were following the fiscal and monetary stimulus, if you will, during the pandemic era. A lot of money was printed. Interest rates were held really low. There was a lot of craziness going on at that time to make it through the pandemic. And now, as we come out of the pandemic, however, we're seeing what all of this has caused, and it is a massive, massive inflation. And so, obviously, for someone who is using dividends right now to pay bills, the dividends that come in pay fewer bills because the cost of the bills typically goes up over time. And it's really hard, you'll be really hard pressed right now to find a dividend stock that is increasing the dividend quick enough to keep up with inflation. Now, keep in mind that whereas inflation right now is hovering around 9%, it may not be that high forever. And so there's always going to be a reversion to the mean, in my humble opinion. And at some point or another in the future, these dividend growth rates hopefully will keep up and surpass even inflation again. But for right now, that inflation is pretty alarming, and it affects dividend stock investors, but it affects just about everyone. Consumers, if one receives a paycheck right now, that paycheck wasn't increased by 9% over the last year, many are saying that that person received a pay decrease. And so that is the world that we live in right now, an alarming trend that wasn't here just 6 months ago. Let's talk about another alarming trend. As you can see on the screen in front of you right now, what I want to share is just bonds. Well, I guess this isn't such an alarming trend for those who can take advantage of it, but this is something I thought I would never see. The 20-year Treasury bond is now yielding 3.418%. I have a Patreon, by the way. I have 2 levels on Patreon. Check it out in the pinned comment below. On the corner patron tier, I share some insights about my bond portfolio. I actually share my complete bond portfolio. I've been purchasing some Treasury bonds because the yields are so strong, and I'm using that passive income to supplement my dividend income strategy. But anyway, I just participated in a Treasury bond auction, and I locked in a really solid interest rate, similar to the one as you can see on the screen right now, which is hovering around 3.418%. But what's so interesting is if you go back just 6 months in time, or so, 7, 8 months, November, December of 2021, the Treasury bond, the 20-year, was yielding in the 2% range. Now, I bonds, which I've also covered on this channel, are now yielding 9.62%. Those are indexed to CPIU. Those reset, I believe, every 6 months in terms of the current CPI rate. I love I-bonds. I think I-bonds are amazing. There's a $10,000 cap per year. I'll link in the pinned comment below to my video about I-bonds. These aren't necessarily alarming trends in some ways because it's exciting to take advantage of an I-bond investment opportunity. It's exciting to be able to buy Treasury bonds at a somewhat reasonable interest rate. So from that standpoint, it's exciting. But it's also alarming that the government issued savings bond product is now yielding 9.62%. That's alarming in many ways because the government is admitting that inflation is that high. And if the government is measuring inflation that high, how high really is inflation right now? And so it's a barometer for where inflation is at. And inflation is out of control, in my humble opinion, right now. And so that's another trend I'm seeing right now that wasn't here just 6, 7, 8 months ago. As you can see on the screen in front of you right now, I want to share trend number 4. That's geopolitics. I follow a lot of geopolitics. I follow some seminars that I take for my work that I do, for my investing. And one of the things that these analysts always do is they try to define a new era. Like basically a certain war breaks out or a certain major catastrophe happens, and it usually rings in a new era. Well, just here in 2022 in February, unfortunately, we have this geopolitical situation in Ukraine involving Russia and Ukraine right now. Now, I also want to point out, however, that there wasn't just one major thing this year. This is another trend right now that really started in April, but it continues through now in July. And I'm reading all the time now that consumers in China are having difficulty withdrawing their money. In the Hainan province, from certain banks, they're having trouble withdrawing their money. And you're also seeing some of the Chinese now are boycotting their mortgage loans. And they're under contract to purchase homes. The homes aren't ready yet to move into. And so they're starting to boycott payment of those mortgage loans. And you're starting to see some strife in China as it pertains to banking, money, and mortgages. And some of this, in many ways, echoes the sentiment here in the US, where you see social media really taking hold. And you see social media people getting riled up, and they're kind of looking differently than they might have done in the 1990s towards banks and towards the wealthy elite in terms of different people. There's a lot of tension, if you will. And so you're seeing these defining moments right now in 2022 that I think when we look back 10 years from now, these are going to possibly ring in a new era. And you're seeing these defining moments speed up in pace. It's not that we just got a war. It's not that we just got a pandemic. But now in China, we have people basically making a run on the bank. They can't get their money, and we have people refusing to pay their mortgages. These are big events, people. And so I'm not trying to say that stock market investing or dividend stock investing doesn't work anymore, but I'm trying to say we live in a brand new world. And as an investor, it's important to be really understanding of what's going on out there. Check it out on the screen right now. I have another trend that I want to share. Number 5, fiscal and monetary policy is out of control. And so we have fiscal policy, government spending. We have monetary policy, central banking. I'm not going to go through all the details because I've covered some of these on the channel before. But let's just look at the national debt. The national debt in the United States has now crossed 30 trillion. This is an alarm bell if I've ever seen one, because back in 2018, the national debt was 21.5 trillion. So we've gone from 21.5 trillion in 2018 up to 30.591 trillion today. Now, we all know about the stimulus checks. We all know about the PPP loans, many of which were forgiven. And we all know about interest rates being held low for too long. And are the Fed's actions right now too little, too late? We don't know. But it does seem that a lot of these experimental policies of the last few years are just that, experiments. And now we're starting to see the outcome of what these experiments have created, and they've created a 2022 which is absolutely insane. Let's talk about some more alarming trends, macro trends that affect dividend stock investors and all kinds of investors. Check it out on the screen right now. And so the next one I just want to share is global health. We don't want to forget that we're just emerging from a pandemic, but is it really over? I'm reading about new diseases every day. There's new diseases spreading now, and there's still continued lockdowns in China, for example, for time to time that affect dividend stocks I own, like SBUX. This is a trend that's been more than just the last 6 months, but the reason I'm bringing it up as an alarming trend is I think a lot of people believe, oh, the pandemic is over. Now, with my sickness over the last week, I tested negative for that virus that caused the pandemic. That being said, I had some pretty nasty symptoms, so I was basically quarantining and taking it easy from that standpoint. But what I'm trying to say is I'm hearing about just how easily these viruses are spreading and mutating, so on and so forth. Is it really over, or is an alarming trend just around the corner? And of course, those types of trends affect investors and the economy. And can our economy really shoulder another pandemic like that after our national debt has gone from 20 trillion to 30 trillion over the last one? I don't know. And so let's keep going. As you can see on the screen in front of you right now, we have an aging population. There's 10,000 new retirees per day here in the United States. And a lot of these retirees are expecting entitlements that they were promised. They're expecting pensions and retirement funds and government programs and Social Security. And I read about Social Security, for example, making adjustments now, cost of living adjustments that's going to adjust up for inflation. But where is that money going to come from when the working age population is pretty small these days, and it's only going to get smaller over time? Who's going to make up that gap in productivity? How is this all going to be paid for? There's going to be fewer working to support all of these entitlements of the aging population. And so we have quite a few trends here that are alarming from a macroeconomic standpoint that affect the overall landscape. And so I want to share trend number 8, as you can see on the screen in front of you right now. The next trend is, here's something really recent. Let's just look at blue chip tech stocks. They're tanking. Who would have thought? Just last year, some of these really popular stocks, FANG stocks, best of breed tech stocks, Netflix, for example, just a year ago was at 532. Now it's at 190. It's down 64% year over year. A lot of people give me trouble over Bitcoin being down. If you look at Bitcoin over the last year, it's down 28%. That's a lot better than Netflix being down 64%. Now, it goes without saying that dividend stocks are really crushing this environment. As far as investments go in this crazy environment, dividend stocks are one of the only asset classes that are performing reasonably well. Amazon stock, which my wife owns, by the way, has gone down 35.9% year over year. Meta stock is down 50% year over year. And so we see some of these blue chip tech stocks just tanking. This is something that really changed in the blink of an eye over the last year. And a lot of investors who are not focused on dividends, a lot of investors who are not enjoying cash flow, who are really focused on growth, they've been hit really hard because the economic environment, all of these nasty trends that I just pointed out, they're especially hitting at-risk asset classes. And with that, I want to share a ninth alarming trend. As you can see on the channel screen in front of you right now, I have a whole channel dedicated to crypto. But crypto right now is facing some nasty liquidity issues. Back in May of this year, Terra USD, which is a pegged coin, pegged 1-to-1 with the US dollar, basically the peg collapsed. And this particular coin, about $60 billion in value was destroyed. A lot of analysts out there are looking at this Terra USD collapse, and they're equating it to kind of the Lehman Brothers issue that was faced during the great financial crisis. And it was kind of that first domino that fell that really sparked a liquidity crisis in the crypto market. Now in June or July, this is really recent, there's a hedge fund called Three Arrows Capital. It basically collapsed, and now they owe $3.5 billion to over 27 different creditors. 2.3 of that billion is owed to one creditor, Genesis Company. And so to my understanding, a lot of the issues at Three Arrows were started, though, by this first domino that fell with this Terra USD. I think they were also highly leveraged in this crypto market, and the crypto market started tanking. And so these are some nasty trends right now. And it's not just that there's one trend. It's not just that there's two trends. I'm pointing out 9 trends here simultaneously that create a 2022 that is unlike any year I have seen in my history as being a stock market investor. Now, one thing worth pointing out is Bitcoin has weathered the storm quite frankly all right. It's down 28% year over year. But I think a lot of investors, myself included, have learned the lesson: not your keys, not your coins, with the liquidity crisis that is hitting the market, that a lot are equating similar to that Lehman Brothers crisis back in the great financial crisis. And so I'm going to keep going, but before I do, put in the comments below, are there any other nasty trends or crises that you're seeing in the financial markets right now that give you concern at home as a stock market investor, as a dividend stock investor, as an income investor, or any kind of investor? I'm seeing 9 of them right now. And like I said, usually in a bad time or in a recession, if you will, you'll see a few of these. But having so many bad things happening all at once, to me, causes a little bit of concern as an investor. And I'm pointing it out there in the community right now because I want to share the story that any kind of investing right now carries more risk than I have ever seen before, because there's just so many things that could fall apart. It's a house of cards. Like I said, if we have one more pandemic, can the national debt in the U.S. really shoulder going from, say, 30 trillion up to 50 trillion or something now? I don't know. Quite frankly, with interest rates on the rise, with inflation out of control, does any of that work anymore? Is that even possible? Can the government even service its own debt? I don't know. I look at it a bit as a house of cards, but I also continue to invest in world-class companies that have pricing power because I just don't see any other way out. I don't see any other investing vehicle, for myself at least, that provides a better long-term return than dividend stocks. But I'll get to that in a minute. But first, check it out on the screen right now. This is trend number 10. This is the U.S. stock market all time. You can see up and to the right. Of course, the U.S. stock market has faced setbacks before. Of course, United States has faced setbacks before. Of course, all countries in this world have faced setbacks before. But what this chart shows is that we tend to prevail. We tend to march forward. And so despite all of the 9 alarming trends, trend number 10 is what keeps me focused on the long run because I'm a long-term investor. As the market trends down, I'm taking advantage slowly but surely of buying opportunities. My patrons know that because I share my trades over there for all of my patrons. And with that, what am I doing in dividend stocks right now? As you can see on the screen in front of you right now, what am I doing? What does this leave me? Well, There's a flight to quality. I'm really about core stocks these days. I'm super laser focused on core dividend stocks. Those companies like Johnson & Johnson, Starbucks that can weather the storm, that can make it through, that have pricing power, that have a competitive moat, that have a sticky product, that have strong balance sheets, although I could argue that Starbucks could be a lot better. I guess better balance sheet company than Starbucks. Maybe I should mention PepsiCo or something like that. But I focus on what I control. Our world is in flux. All I can do is keep building income one step at a time. What else can I do? I can't control the GDP. I can't control inflation. I can't control the pandemic. I can't control our crazy politicians. I can't control social media. I can't control a run on the bank, all these types of things that's happening over there in China right now. I can't control it. But what I can control is what I do. And I'm just building what I can do with my dividend stocks one step at a time. I have patience. There's no rush to deploy too much capital at once because I think these buying opportunities could be around for a while. I'll just keep dollar cost averaging. I understand that losses happen. Some of my at-risk assets have gotten hit pretty hard. I've spoken about this over on my crypto channel recently. I have low-risk assets like dividend stocks, like Treasury bonds that have weathered the storm incredibly well. It's impossible to predict the future. I need to practice wise asset allocation, but I also don't want to be too hard on myself because, quite frankly, this is an investing environment unlike anything we've ever seen. I want to manage inflation a little bit on my end. Inflation is real, but I can control my own cost of living by staying frugal. Also, where does this leave me? There's only one strategy that I've ever really seen work for me, and that's core dividend stocks. And I've tried it all. Seriously, I have tried it all. I love an economy like this, if for no other reason than it shows us all which strategies work, which ones don't. Sometimes I need a reminder. I think any investor does, and it always brings me back to income investing, to core dividend stocks, to core income investing, quality companies. Those are the types of companies that are performing really well in this market, such as Johnson & Johnson, Starbucks, PepsiCo, so on and so forth. If you enjoyed the video today, everyone, please go ahead and smash the like button. It means the world to me. And again, I look forward to seeing you in the comments. Let me know if you have found any other alarming trends out there. A lot of these trends have shocked me. I couldn't have predicted them, that's for sure. Also, don't forget to subscribe with that notification bell. I love you all. I really appreciate you hanging in there and waiting for this video. I'm so excited to be back. Before I go, in terms of a full disclosure, I own the stocks mentioned today. I'm long Johnson & Johnson, ticker J&J, PepsiCo, PEP, Starbucks, SBUX. My wife is long Amazon, AMCN. I'm long Treasuries, Treasury bonds as well. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's for your fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a lot of money in stocks, financial markets, investing. As I mentioned in the video today, there is more risk than ever before with these 9 nasty trends that I am seeing out there in the marketplace. So I'm just sharing my journey for fun and entertainment. I love you all. I'm going to see you in the comments below. Thank you for watching the video today, and I'll see you in the next video.